Hello, welcome everyone to this discussion on private credit opportunities. My name is Cate Ambrose. I am the CEO of an organization called the Global Private Capital Association. We are a nonprofit independent membership organization of private capital fund managers and institutional investors active across Asia, Latin America, Africa, Central and Eastern Europe, and the Middle East. Today's conversation will be exclusively about the U.S. market, maybe touch on Europe, so I'm going to take 2 seconds to give a little global context. The amount of capital that's been raised for private credit here in the United States is extraordinary. It's grown tenfold over the last decade, and $570 billion has been raised since 2013. So really, I think this will be one of the topics of conversation for the panel is just how large the market has become and how competitive it's become here in the U.S. and growing in Europe. However, it is expanding in other parts of the world as well, particularly in Asia. Nearly $12 billion was raised in 2021 for private credit funds targeting global markets, and an additional $8 billion was raised in the first half of 2022. LP interest has been growing due to lower yields in the U.S. and Europe, as well as diverse opportunities across distressed and special sits. Worth mentioning that Ares acquired a local player in Asia and closed its third Pan-Asian fund earlier this year, focused on lending for $1.6 billion. Bain and Apollo have also both closed on billion-dollar-plus funds for Asia in 2022. I noted that actually we have Oaktree on the panel today. Oaktree went into Latin America along with Apollo and committed a total of $3.2 billion to support the restructuring of LATAM Airlines in 2020 and 2021. So there is activity in this space globally, and I think the important note is as you see the maturation of the U.S. market and just the scale of credit that's available, there will be more of a push into global markets as well. So having set that context, I think we'll jump right into the panel discussion. Really delighted to have with me here today Phil Tseng, a managing director with BlackRock, Nicole Drapkin with Owl Rock Capital Partners, and Christina Lee from Oaktree Capital. And we're just going to kick it off by asking each one of them to speak for a couple of minutes about their firm and their strategy. What type of private credit are you providing to what types of businesses or clients? A little bit the scale of the types of tickets or credit that you're providing, risk profile, and anything else you want to share. Maybe we'll kick it off with you, Nicole, first.
Sure. Hi, nice to meet everybody. I'm Nicole Drapkin. I'm a portfolio manager with Blue Owl. Blue Owl, for those of you who don't know, it's an alternative asset manager that provides private capital solutions. We manage about $120 billion of assets under management across 3 core strategies: direct lending, our GP capital solutions business, and real estate. I work within the Owl Rock direct lending platform. We have about $57 billion of assets under management across a few key distinct strategies: diversified direct lending, first lien lending, technology investing, opportunistic investing, and first lien lending. We primarily operate in the U.S. middle market, catering to borrowers of 25 million plus of EBITDA, primarily around financial sponsor-backed businesses.
Great. Christina?
Hi, I'm Christina Lee. I'm a managing director at Oaktree and the assistant portfolio manager for our U.S. private debt strategy. Oaktree Capital is an alternative asset manager with about $160 billion of assets under management. We primarily focus on credit with about 70% of our AUM in those strategies. The strategy that I sit in is our private credit or direct lending platform, where we provide private credit solutions to both non-sponsored and as well as private equity-backed solutions, primarily in the U.S. and primarily for U.S. middle market borrowers. I specifically mostly focus on the sponsor-backed business.
Hi, my name is Phil Tseng. I am co-head of the U.S. private capital business at BlackRock. We are the private credit portion of the BlackRock alternatives business, which manages about $300 billion. Private credit in the U.S. is roughly about $20 billion.
We provide access to our products through a number of vehicles, including non-traded BDCs, publicly traded BDCs, commingled funds, separate accounts, and so on. One of the areas that kind of differentiates us in the market, not only do we provide traditional middle market financings across a variety of industries, for companies 25 million of EBITDA and above. But we've been in the business for about 20 years, doing the exact same strategy as we've been doing today. So I think we have one of the longer standing track records, but not only in direct lending, but broader in private credit, as we manage both special situations and private credit strategies, and apply the same underwriting and sourcing framework for both.
Great. Yeah, I think there'll be a lot of talk about direct lending because it's a big part of what's happening here, but there are other strategies as well. So first, just to contextualize this exponential growth in the private credit space over the last decade, maybe, Christina, you can kick us off on what is driving that growth and what are the mid to long-term growth prospects in terms of the market capacity to continue to expand.
Sure. So direct lending has grown substantially over the last decade in terms of AUM and in terms of entrants in the space. I think initially where private credit or direct lending was really taking share was after the last recession, and with the Dodd-Frank legislation, direct lenders were taking share from banks. I think with these new regulations, banks were less willing or able to finance middle market borrowers, and so you saw an uptick in share from there. I think also when the public markets are volatile like they are today, you are seeing an accelerated market share gains from private lenders because we are able to provide access to financing without the uncertainty that the private market or the public markets are currently providing. I think too, borrowers are just getting more comfortable with private lenders. I think they see an ease of execution with it, whether it's just one lender or a handful of them. And then three, as Cate has mentioned before, LPs are more interested in the asset class. It does yield more than public markets due to the liquidity premium. Two, it's less volatile because we're not necessarily marked to market. And then three, I think there's a better kind of risk return because you are able to do more private equity style due diligence, have better covenants, have better access to management teams as well. And I'll kind of kick it to Phil to talk about kind of the future. And
Yeah, I'd echo a lot of what Christina mentioned. I think what's really important is that private credit's now seen and performed through multiple cycles now. So it's become a much more adopted and mainstream asset class. So for folks that are looking at, what really is the risk that I'm taking with these private deals versus perhaps going after liquid loans or high yield, you can now look over multiple cycles, even going back 20 years. Certainly in our case, having gone through the GFC, gone various shocks with commodities, various geopolitical issues, and seen that private credit's actually delivered sustainable returns over a long period of time. So I think that's really important. And really, private credit, especially direct lending, is becoming a really core allocation for a lot of investors. At the same time, not only are the returns sustained itself, but the risk has shown itself to be superior to liquid credit. I know the loss ratios, for us at least, are over the last 20 years have been better, even defaults and recoveries, and better than the liquid markets. And what that's led to is not just being a core allocation, but now there's more access to private credit as well. That's really driving the growth. Think about access to retail. Retail investors now have the ability to access our funds or our portfolios through non-traded BDCs and publicly traded BDCs and so on. And that's really starting to open up the market, and rightfully so.
Great. Maybe just interesting to note on the retail side, do all three of you raise money from retail investors as well?
We do.
Yes.
Okay, interesting. Okay, so drilling down a little bit in terms of specifically what's driving the opportunity today, what sectors, strategies, that type of thing. Nicole, maybe you can talk a little bit about, again, what are the business sectors that you see most relevant now? What themes or strategies are most relevant in the market?
Sure, it's a pretty interesting deal environment right now in 2022 versus what we saw in 2021. You've certainly seen a massive slowdown in kind of traditional sponsor-backed M&A, but kind of the broad-based corporate M&A environment as well, really kind of driven by a weak equity market backdrop. We still continue to see a tremendous amount of opportunity in certain sectors, primarily software and technology. We've seen incredibly high quality deal flow, albeit in fewer situations. Interesting thing we're seeing in the market right now is just tremendous number of public to private transactions. So public company boards that have largely gotten their arms around going private, as opposed to really a continued disconnect between buyers and sellers in the kind of core private equity universe right now. A lot of those transactions are getting financed in the direct lending space. And so what you've seen, kind of given the volatility in the markets right now, is this massive pullback by banks. And in order to get deals done, you've really had to come to the direct lending market in order to secure financing. And so access to that financing has kind of largely driven the ability to get deals done in a way that you don't traditionally see when the investment banks are kind of really open for capital commitments. So that's one area we continue to see. Another really interesting part or sector of deal flow we're seeing is in higher growth businesses, primarily within the technology and software space as well, that don't have access to the IPO market or don't have access to kind of traditional VC dollars at valuations that they think are warranted. And so we've seen a lot of borrowers kind of weigh that option between taking structured debt in some way versus taking a down equity round and kind of what that means from a dilution perspective. And so we've largely seen a kind of uptick in really high quality businesses that are still kind of in this growth part of their curve that have never been open to taking debt before, that have kind of now accessed our markets in a kind of more regular way.
Great. Maybe you can share an example or two from of a public to private deal that you've done recently.
Sure. From that landscape, all these deals are kind of publicly filed, and so the commitment papers are there. But you've seen kind of a host of kind of public to privates in the software sector getting done recently. SailPoint, Ping, Avalara, probably the kind of three, Zendesk being 3 or 4 of the largest, which I think various of us have participated in. All of these deals characterized by $2, $3, $4, $5 billion financings in many respects, all getting done in the private markets. And kind of what that's been driven by is exactly some of the stuff that Phil's been talking to. More players, more institutional quality players coming into this sector, a general comfort that now private equity holders have with going to the direct markets for their financings. And I think COVID accelerated a lot of that. Partnership-driven models, the ability to customize financing solutions in a way, and to know your holders. When things go wrong, these aren't deals that are kind of syndicated to hundreds of investors. There are 5, 6, 7 of us that are kind of looking to be long-term partners with companies.
Great. And Phil, maybe you can share a little bit on what you're seeing and drill down a little on some of the sectors.
Yeah, sure. So on the traditional direct lending side, we get asked that question a lot, especially in the last 3 months, given the geopolitical issues, given supply chain and inflation issues and so on. But we've been doing this for a long time. I think all of us have. And I think they'd all agree, if you're trying to pivot your portfolio today, or you're trying to make some adjustments to what you're doing, you're 2, 3, 4 years too late. What we invest in are illiquid assets. We're creating these assets from scratch. We're putting them into our portfolio. They're not liquid assets. So really, you should have been thinking about economic uncertainty 2, 3, 4 years ago, or rather at all times. And that's kind of the approach that I think we take in direct lending, which is these aren't liquid assets. So we should always thinking about, all right, if it's not going to be a geopolitical issue, could it be a consumer demand issue? Could it be something else that we just can't predict? But you have to position your portfolio in that way. So the sectors that we tend to focus on are the same that we're focusing on today, which is around largely non-cyclical areas where there are companies that can weather certain shocks and storms. So we spend a lot of time on, non-high fixed cost businesses. So a lot of service-oriented businesses with high visibility revenues, where if things do get bumpy, you can cut costs. A lot of variable cost structures, rather than being burdened with a tremendous amount of capital equipment or high fixed costs, for example. So things like healthcare services, technology-enabled services, even industrials. But the industrial businesses we invest in are more the industrial services companies that have high visibility. Think, your HVAC maintenance equipment vendors. So they're always in business, whether it's hot, cold, slow, or robust demand economically. So those are kind of the areas that we tend to focus on.
Great, and you're both talking about mid-market. Maybe we can just quickly define what the mid-market is, say in the U.S. context, both in scale of the company itself, annual revenues, and then maybe the kind of scale of credit that you're providing.
Yeah, the middle market that we tend to focus on are companies with roughly about 100 to maybe 500 million in revenue, and certainly upwards of 25 million and up in EBITDA. So these are businesses, importantly, they're not too small, whereas they're not meaningful to their customers, or they don't have too much customer concentration or geographic concentration. Those are the lower end of the middle market, I think is how I characterize it. The size of businesses that we focus on, they have the ability to restructure, right? We're always thinking about downside in our business, and when companies go through restructurings, it's a really costly process. Lawyers make out the best in all restructurings, as we all know.
Get some advisors in there.
And advisors. So it really takes a lot of liquidity out of the borrowers. So you have to be of enough scale to weather those types of processes. And we think that the size that I mentioned does allow you to do that.
If there's nothing else on that. Maybe, Christina, we'll jump to you. Just we're in a new environment now. Obviously, there's been a dramatic shift in terms of the inflation and interest rate environment. And I'm assuming that's having an important effect on the risk-return profile and the types of opportunities and pricing that you're seeing in the market. I certainly see where for private equity, it was very easy to pile on leverage for many, many years at a very low interest rate. And it's going to be a lot more challenging going forward. So maybe just share a little bit on how this macro environment is affecting the market.
Sure. Maybe I'll first touch upon kind of the rising interest rate environment. So a lot of us direct lenders, including everyone on stage, a lot of our debt is issued as floating rate debt. So there's a natural hedge in terms of rising interest rates where your all-in yield is rising alongside the rising interest rates. I think on the flip side, though, is as those interest rates rise, you have to make sure your borrower makes enough EBITDA to cover fixed charges. I think for some larger deals, especially in the public markets, I call it that they were levered to perfection. So when they were going into that capital structure, there was not a lot of cushion for fixed charges. So I think it'll be really interesting to see how that plays out over the next few quarters. But really in the middle market space, when you look at leverage and fixed charge coverage, I recently saw a stat that I think on average across the survey of about 150 mid-market borrowers, interest coverage was 2.5 times. So with the 2.5 times interest coverage, despite kind of interest rates rising 50, 100 basis points, there'll be more than enough free cash cushion to cover your interest. And I think that's one of the great parts about this asset class is we're not the most aggressive leverage takers in terms of leveraging things to perfection. As Phil mentioned, we always think about not when a recession is going to hit, but if it does, what will happen to that borrower at any point in time. But you are seeing in the market that leverage is coming down as that recession risk is rising, as well as interest rates are rising. I think the third question people always ask about interest rates is, we are reliant on deal flow. What's happening with deal flow? With rising interest rates. I think historically when you looked at this asset class, even during rising interest rates, there has been significant deal flow. There's 200,000 unique middle market borrowers here in the US. It is a very large addressable market. And then on the sponsored side, the amount of dry powder in private equity right now, I think will continue to fuel deal volume in this market. Then kind of touching upon inflation, I think about it from a borrower's perspective. I would say across the board, we have seen borrowers' revenues increase over the last 12 to 18 months, as many borrowers have kind of increased their pricing in order to offset inflation. But then when you kind of look at profitability, I've seen a little bit more of a tale of two cities. You have those borrowers that, yes, they've increased pricing, but they were not able to increase it fast enough to offset inflation. For example, borrowers that have a heavy reliance on ocean freight to get their goods, that pricing accelerated in Q4, and you're really seeing it impact their bottom line today. Then there's another side of it where you're seeing inflated profitability as some borrowers are frankly making a spread on some of their COGS rising. And I feel like that's where the question boils down to is what is your pricing power? I think, Phil, you mentioned that HVAC repair business. Those types of businesses do have pricing power. There are small costs, but mission critical, and you have to fix it when it breaks. Those are the types of companies that have been really able to aggressively pursue pricing.
Great.
Yeah, I'd say just back to kind of the broader interest rate question for a second. Obviously, most of what we do is floating rate. We're benefiting from kind of an increase in rates broadly. The volatility in the market, you're also seeing spread widening, which kind of further helps kind of all-in returns. The kind of other side to that, though, is we're seeing better documentation protections. So this focus on kind of quality of EBITDA that we're underwriting, the ability for borrowers to kind of spin out assets or kind of get rid of collateral, to take restricted payments, any type of asset leakage, that's moved very favorably into the lender camp over the course of the last 3 to 6 months. So we're seeing this kind of double-edged sword with increased rates kind of on our half to be able to kind of drive better returns coupled with better documentation protections. And so even though you're seeing a little bit of a slower deal volume, you're also seeing kind of better deals that are going into the portfolio, coupled with what's really interesting in today's environment, we're seeing much fewer repayments. I don't know if you guys are seeing that in your portfolio as well. So a little bit less reliant kind of on huge new deal flow that existed in 2021 because the pace of refinancings has certainly been slower.
Interesting.
Yeah, I think interestingly, what's happening now on the deployment side is a lot of our existing portfolio companies are coming back from our capital. So what we're finding is that a lot of our deployment comes from our existing portfolios, roughly about 50% in the last couple of quarters, which is high. But that makes sense because a lot of our portfolio companies today, they're taking advantage of the economic environment to go acquire some of the smaller strategic targets in the market. Perhaps they need to sell given the environment, both from a cost like wage inflation or other type of inflation. And so some of these smaller sellers might be more willing to sell. So we're having to re-up a lot of our debt in existing portfolio companies. But what's interesting is that the incremental debt that we're issuing to these portfolio companies are coming at a higher price. Interestingly, 12 months ago, we financed an insurance brokerage business. It's in the financial services, high recurring revenue given the visibility of renewals and so on. And we priced that loan, let's say roughly at SOFR 550. We just did an upsize 2 weeks ago, or at least committed to one, and that's being priced at SOFR 675. So, and all the meanwhile, in the last 12 months, the business has performed great. We've seen management execute, and leverage profile is roughly the same. So there at SOFR 675, you're getting 125 basis points increase on the spread, and you're getting an increase on the base rate, with SOFR having gone up to now, it's around a little more than 3%. So as you can see, the environment for deployment is actually quite rich right now and really attractive. But a lot of it's coming from our existing portfolios.
Interesting. Is there any sector or segment of the market that you expect to see drop off as a result of, when we talk about the ability to pass through pricing, inflation and that type of thing to consumers or B2B? Is there anything that's not going to look good in this environment that you were doing before?
Well, we're really focused on wage inflation. I know from running my business, or a lot of people-driven businesses, whether you're working on the assembly line at a chip manufacturing company or packing Amazon boxes, it's hard to pay your employees less than they made the prior year. It just is, right? Obviously, there's general inflation, so the cost of living has gone up. That may start to stabilize, but wage inflation is sticky, in my opinion. And I think for a lot of service-oriented businesses, that's going to be an issue, and it's one that we're monitoring closely.
Now, what about moving just beyond sort of plain vanilla direct lending special situations, which can be a grab bag, a lot of different types of things. Nicole, you want to share some of the things you're seeing in that space?
Sure. I was joking with Christina because I normally take a run at Oaktree when I get asked this question, but. So we have an opportunistic credit business, as both of these guys do as well. It can cater to a wide variety of situations. We kind of look at ours as a little bit more situational capital, but kind of runs the gamut, obviously, to core distressed or kind of even private equity in some respects. You're seeing a lot of opportunity there, still in businesses that are performing or meeting their metrics, but may have liquidity challenges. The kind of equity fundraising isn't necessarily there. They may be too early in their growth stage for traditional institutional capital, or they may not want to sell themselves yet. And so you have this unique environment where some type of structured debt is kind of really finding its way into the market in a way that it probably wasn't in 2021 because it couldn't compete with the equity markets or it couldn't compete with the private equity markets in some respects. So you're seeing a lot of that. On the distress side, obviously there's a lot dislocation driven in the public markets. It's some of what's driving, obviously, the kind of increase in deal flow into the regular direct lending market. So there's a lot on the dislocation side, kind of all credit specific, obviously. And then on the distress side, certain investors are finding pockets to deploy. These guys are probably better suited to discuss that. But a kind of a lot of asset stripping ability to kind of really find liquidity in situations and businesses that are underperforming.
But that presumably still are attractive from a long-term
that is the hope. Certainly a lot of investors that are kind of jumping in with a view to the fulcrum and ultimately taking over businesses, I think is probably the end game.
Christina, you're able or not able to say something on this topic? I know you're limited.
They're very good at it.
We are limited about talking about the specifics, but I think, even opportunistic credit has still been an attractive asset class, despite the fact that for over 10 years we were in a great economic environment. And I think this volatility only helps the cause, frankly.
We are seeing a lot of opportunity in businesses that are going through some distress, where because we don't have an affiliated private equity fund, you're kind of getting a lot of looks at kind of earlier stage liquidity help before they kind of go broader out into selling themselves in some respects.
Yeah, one of the things that we like to say in terms of what always drives the opportunity set in special sits or opportunistic credit is that, bad management is not cyclical, right? Yeah. So there's always a steady supply of companies that, it could be some bump in the road in the industry, but oftentimes management will make an execution error. And that happens across industries time and time again. It may not be a full tailwind of opportunities in like a true distress cycle, but there's always a pretty steady supply, in our opinion. Mm-hmm. And I think, one of the areas that our opportunistic strategy is certainly interested in now are companies that, for example, unicorns, right? There are a lot of technology unicorns, maybe they're worth $1 billion plus, in the last fundraising cycles over the past 5 years. And there is a core business there. It's just not growing at 50% year over year anymore. So they may not justify getting more liquidity. Maybe they're growing at 10%, but there's a core set of customers that maintain good renewal rates with the customers, but the company's worth much less, obviously. And that's an opportunity to then step into that valuation fulcrum and provide a loan or liquidity to the business and drive an attractive set of returns.
Super interesting, because we had talked in our pre-conversation around the role, lending to M&A and private equity, and you had mentioned, Phil, that venture is in there as well. But tech is obviously such a huge percentage of the overall private sector and just everything that's happening in public and private markets. So, any other comments about tech, B2B, the incredible correction that we're seeing from companies backed by the likes of SoftBank or Tiger or others, and what kind of opportunities that might create in your space?
You're definitely seeing more of those companies look to access more traditional debt. And that's been an education process, because if you're a founder, the prospect of having a secured lender with covenants is very scary, right? If you bust a covenant, now I have to give my business to my lender, like absolutely no way. And so that's been an education process, plus no more access to kind of equity capital in the same way, and or really decreased valuations. That's providing a tremendous opportunity set in businesses really that have huge competitive moats and huge value propositions, but don't necessarily generate cash flow in the traditional sense. And so a lot of it kind of comes down to that structuring around the right business model. But it's been a very slow education process, I think, for a lot of these borrowers and management teams and founders to kind of get their heads around, how do I take traditional debt in a way that's going to work for me, but also kind of protects my long-term ability to run the company in the way that I want to.
And have there been any of those types of companies in the public to private deals? Any notable?
I mean, it'll be interesting, right? All these companies that went public via SPAC that are kind of hovering at these depressed market caps, I imagine that's going to be ripe for private equity over the course of the next year.
There's some good quality assets there. Okay, great. And so just in terms of who's playing in this space, we have three very large, well-known firms. There's been a lot of consolidation. There's, it's, again, as we mentioned, it's grown in scale. How is the entrance of the world's largest asset managers affecting the smaller boutique, players. Again, none of you represent that, but some of you came from smaller firms that merged or consolidated. And does scale matter? Who's out there outside of the scale of the types of firms you represent, lending to the middle market? What do they provide, and how do you compete or play in relation to them?
I'm happy to start. Thank you for saying we're a big asset manager, because we're normally the new entrant that everybody likes to talk about. There have been a lot of institutional scale players that have been raised over the course of the last few years that have kind of really changed the dynamic. I personally do think scale matters. To be able to provide a full, comprehensive, customized financing solution to a borrower is really what wins the day, but also really runs the ability to drive returns for our own investors. So we kind of think about the landscape as a pyramid, and there are a few parties that kind of write very large checks, both of these guys as part of that, but a tremendous number of players that can help round out a syndicate or take smaller checks, but don't influence pricing, and they certainly don't influence documentation. And as a credit underwriter, kind of credit manager, kind of end of day, that ability to protect our downside through documentation, not only asset selection, is incredibly important. Being able to run that process and really drive those documentation terms is really what it comes down to. So, a lot of the broader institutional managers coming into the space, they probably already were, assuming you're talking about Blackstone kind of first and foremost, huge formidable player. We all operate in an environment where there's competition, of course there is. There's also increased deal flow into our market. Market share as a percentage of the general syndicated market, between leveraged loans and high yield bonds has grown exponentially within private credit. And so there's competition, but it tends to kind of work out where everybody's not really going after the same deals and everybody has niches. And certainly with a lot of these bigger transactions, you need multiple lenders. And that's very accretive, at least to end returns within our space. It'll be interesting to see if some of the kind of more traditional private equity firms move into direct lending or private credit specifically. You're certainly starting to see that. But some have held true to their knitting as well.
Yeah, and I think scale matters also from deal flow perspective. Having strong sourcers and originators and scale matters with that. I think also when you come to larger transactions, it is less fragmented than I would say, for example, the lower middle market, which I would describe as kind of 5 million of EBITDA to that 25 million range. There is a lot of providers, but there's only so many that can hold kind of that $100 million plus check. Everyone on the stage here can. So I think it's kind of it's a weird dynamic where you're competing, but you're also relying on each other to fill out each other's clubs as well.
So I can speak to this from a little bit of personal experience because I managed a business called Tenenbaum Capital Partners, which was a boutique private credit manager up until 2018 when we were acquired by BlackRock, which is the largest asset manager in the world. So I've seen both sides, and I can, just based on my first-hand account, can talk about some of the benefits you do get from scale. And that was one of the drivers of the transaction for us as partners at Tenenbaum. But being part of BlackRock has been truly a case study in scale matters. Just to touch on the point that Christina brought up around origination, for example. So, and I thought at Tenenbaum we punched above our weight. We were doing great on origination. We did, we found a lot of deals and proprietary deals. But then when we got to BlackRock, what we found was there are a couple of key areas that scale helped. One is, it's kind of cliche, but we were truly becoming a life cycle solutions or financing provider to a company. So think about if you're a CFO or CEO or maybe a director on the board of a business. All things being equal, so far we're seeing them really value having a larger suite vendor here. So think about this. If a company is maybe earlier stage, maybe they'll need venture lending, maybe even venture equity. We can provide that. Then as they grow and become, more of a growth beyond kind of Series B, C, and more of a growth equity or growth lending situation, we have the product to satisfy that in our business. And then when they're ready to go public and hit the equity markets, guess who one of the biggest tickets is in your IPO book? It's going to be BlackRock. And then when you're scaling and you're ready for a broadly syndicated loan or even a high yield deal, or even you're doing a cross-border financing because you're doing more M&A, BlackRock is going to be in your capital structure somewhere. So that life cycle of solutions for borrowers, in our opinion, has really been helpful, and we've seen that. And it's really generated much more incremental deal flow. And then on the non-origination side, what we've seen from scale is risk management. I think that's really important for all our businesses, right? And while we thought we did it pretty well as a boutique, actually having a true systematic approach to risk management with a tremendous amount of resources like we have at BlackRock. I mean, if you think about BlackRock and its compliance and risk management infrastructure, it's quite tremendous. And now our clients get the benefit from that relative to the boutique's amount of resources.
You did mention when we were talking previously, there's a relationship element here. I think one of the previous panels or discussions was around, relationship building, and at the end of the day, the products aren't dramatically differentiated despite everything that we're saying. So I'm imagining a huge part of this is, again, you're collaborating, but you're also building relationships with firms over time that drive new opportunities.
Well, and Phil had talked about this earlier, kind of the add-on activity across his portfolio. One of the real benefits to all of our businesses in the middle market is a lot of these businesses stay private for a really long time. So they may switch owners from one private equity fund, they may go public, they kind of go through a life cycle, but getting to know a management team and really understand their business lets us scale quickly with regards to diligence. We also understand the pitfalls, but also saves the management team from having to re-educate investors about exactly what their business does. And it's a very seamless process with regards to quarterly reporting or quarterly lender calls, and kind of a seamless flow of information that's really, really valuable to management teams. It makes the process much more seamless as they kind of think about their strategic priorities within a business.
And I also think we are buy and hold investors. We are in a company for 3 to 5 years. It is a long-term relationship, and I think one of the reasons borrowers also tend to like private credit is there is a relationship. As Nicole was saying, there's not 100 people in your club, so that relationship is so important because your debt is held by either one person or, say, 3 to 5. It's a small group.
And another way, Cate, that large asset managers, I think, are impacting the private credit market is on the fundraising side.
That's true.
Large asset managers inherently have a deeper set of products that they can become much more relevant to clients and investors. But not just the types of products, like whether it's opportunistic or whether it's traditional direct lending or venture lending or what have you, but also the types or the vehicle types, right? The fact that we can now offer non-traded BDCs and invest in the cost of getting them up and running and marketing it broadly, both domestically and offshore, or managing traditional publicly traded BDCs or middle market CLOs or having more separate accounts and things like that. There's a lot of cost in that. And the fact that as a large asset manager, you can, carry that burden and capitalize it across more capital really helps.
That's a perfect setup for the last topic I wanted to pivot to. Again, the scale of both equity and debt available in the market is really breathtaking. I deeply believe that capital is the ultimate commodity right now. What's a very limited resource is human capital. Financial capital is very available. Human capital, we're talking about relationships here. Somebody has to be managing those relationships with those borrowers, the companies themselves. You touched on this before, Phil, in terms of, the higher cost of employment and salaries going up. So in the midst of this acute labor shortage, especially for the most skilled workers, how is that affecting the business model? What kind of bottlenecks does that have the potential to create at the firm level and then more broadly in the businesses and sectors that you provide credit to?
I think like a lot of asset managers, we were, and actually a lot of Wall Street, to be honest, there was a higher rate of departures, especially amongst the junior ranks. No surprise, during the Great Resignation or the Millennial Movement or so on. I'm not quite sure I know what quiet quitting is yet, but I'm still trying to figure that out. But certainly we saw a little bit more turnover on the more junior folks. At the same time, we've hired to more than compensate for that actually. But I think at the end of the day, our business is spending more. And so are we going to run our business at a lower margin to make sure that we have enough resources to take advantage of the opportunity set? We will. And we'll do whatever is right for the clients. And if that's what it means, then that's what we'll do.
And I think historically, for example, our pipeline of junior resources or associates came from investment banks. So they would do a 2-year analyst program and then come to what we call the buy side or into private credit. I've noticed more and more firms are now kind of going straight to undergrad to build that pipeline, because I think what we've all probably witnessed over the last few years is that pipeline from banking has shrunk, whether it's people staying in banking or frankly saying finance is not for me for X, Y, and Z, I'm going there. And so I think that's another movement, is to go straight to undergrad, to really widen that pipeline, because in the end we are a people-driven business and it really depends on our talent.
I was going to say, I know there's a lot of crypto investors in here, and we had a lot of the junior talent did move to a lot of crypto firms where there's potential for upside and really being part of a great movement. But that's certainly died down in the last 3 months.
Any predictions? I think we're one of the few non-crypto panels at the conference. Maybe we'll keep a dog out of that. Much safer strategy. Any final remarks? Any predictions on where you expect? I'm not going to ask you to predict interest rates. I hear it's going to be 3/4 of a point next time. It's just reading the paper. But any predictions on where the market is going to be? Say 6 months or a year from now, just to close out. We'll maybe go down the panel with you, Nicole.
Sure, I think there's still going to be a moderate deal pace over the end of 2022 into 2023. I think it'll continue to be focused on kind of select industries where buyers and sellers really are able to meet. But I think the cost of financing those are going to continue to be pretty high, and so it's going to be a question kind of around where valuation makes sense, kind of given the increase in funding costs.
Yeah, at Oaktree, we don't believe in kind of macro forecasting as a primary driver of whether or not we're going to invest. But I will say, I think a lot of us are in price discovery mode, as Nicole is mentioning, and kind of seeing what's going to happen in the next 6 months is, I think is going to kind of determine where we price things, but we'll never sit out of the market. It's more of, is this a good value?
Yeah, I think deal flow will be pretty steady, actually. But I think that our portfolio companies and the middle market economy is going to start seeing a greater impact on their business models from the sustained higher inflation and supply chain issues and geopolitical shocks and so on. And so I think that will impact companies. So I think now is the time, because you can't sit out the market in direct lending. Direct lending gives a very steady premium over liquid credit. While we're waiting, investors are getting 8, 9, 10% dividend yields. So it's fantastic, which is a premium to liquid markets, which is fantastic carry. But at the same time, you want a manager that can manage this uncertainty. So if companies do hit walls or do go sideways, that you have workout capabilities and restructurings. And so folks like those on the panel have that skill set, and that's the kind of manager you want managing direct lending in this environment.
Great. Well, I predict that private credit is going to be expanding in Asia and other global markets. It's definitely something that we're already seeing. Sustainable infrastructure and lending to those types of projects is something that's on the rise. So definitely expect to see that. Thanks so much to all of you for your attention, and thank you to the panelists for a great discussion.
Thank you.